Between 2019 and 2021, the S&P 500 did something it hadn't done in over 20 years, and may never do again. It doubled. For reference, the only 3-year time periods the S&P 500 had a higher total return were between 1995 and 1997, 1996 to 1998, and 1997 to 1999. When it produced a total return of 126%, 111%, and 108% respectively. Coming close to a record is one thing. Doing it during a period that was mainly spent in a global pandemic is quite another. The average long-term annual return in the S&P 500 is around 8%. Doubling your money by historical averages would take roughly 9 years. So the 3-year period we just witnessed is truly remarkable. Hi, I'm Kate with The Motley Fool, and I spoke with Daniel Foelber to understand some catalysts that helped the stock market make history, as well as why it could be challenging to match this performance going forward.
So if you look at the S&P 500 in 1999, it's almost unrecognizable from where it is today. The top 5 largest holdings in 1999 were companies like Microsoft, GE, Cisco, Walmart, and Exxon. And the top 7 largest holdings in the S&P 500 at the end of 2021 are mostly the big tech names like Apple, Microsoft, Google, Amazon, Facebook, Nvidia, and Tesla. So those 7 stocks plus the next 3, which is JP Morgan, Berkshire Hathaway, and Home Depot, make up nearly a third of the S&P 500. And those 10 stocks alone had around a 50% gain in 2021. And most of them also have businesses that weren't too impacted by the COVID-19 pandemic. In fact, a lot of their businesses grew. Those 7 tech stocks, I think except for Amazon, all beat the NASDAQ in 2021. So you just look at such strong performance from the top weighted stocks, and that can make up for so much underperformance by the smaller companies. I crunched the numbers, and it's pretty interesting to see that just Apple and Microsoft alone added $4 trillion in market cap between 2019 and the end of 2021, which is pretty incredible. In fact, if you just had the other 498 stocks in the S&P 500 have a 0% return, it would still be up 19% in that 3-year time period just from Apple and Microsoft. And then I think even Apple and Microsoft alone at the end of 2021 are bigger than the value of those top 7 stocks at the end of 2018 combined. It's a very unique 3-year performance that was really carried by those big tech stocks. And whether you held them or didn't, it's easy to feel unrelated to the index, feel like it's very distant from you, because your personal performance or any hedge fund or exchange traded fund's performance can vary drastically from the S&P 500 when you take out those big tech stocks. So the S&P 500 has gotten bigger, it's gotten a lot more concentrated, and it's mainly tech and financials now and a lot less industrials.
That's a good historical perspective of the S&P 500, but how is it performing in recent years?
So I think before any big period of outperformance, it's important to look at how the market was doing leading into it. And 2018 was a pretty interesting year. Going into the 4th quarter, the market was looking good. It was up 9% for the year, but then it finished 2018 down 6%. In fact, it was down more than 20% in the 4th quarter at one point. It's one of those drops that we kind of forget about because it looks just like a blip on the chart when you look at like the 10 or 5-year chart, but it was a very uncertain time. This was when you had new Fed Chair Jerome Powell step in. We have the US-China trade war hitting its full stride. We have an uncertain interest rate policy. So the stock market is down a lot in 2018. But then in 2019, you have the Fed kind of reaffirm that it's going to keep interest rates low. And then it was just a rocket ship from there. I mean, 2019 was one of the best years we've had since the Great Recession. And that low interest rate policy carried forward throughout 2019. And then when the COVID-19 pandemic was at its worst in March 2020, you had both monetary and fiscal policy step in and say, we're going to spend a lot of money, we're going to have a lot of stimulus, we're going to keep interest rates low. And that does 2 things. One, for strong companies like Apple and Microsoft, it provides even more fuel to grow. And then for weak companies, it gives them the dry powder needed to weather the storm. And then it also keeps both consumers and companies, the companies that are the customers of the Apples and Microsoft, with a lot more money to spend. When interest rates are low, when you have multi-trillion-dollar stimulus packages, it's pretty hard for a weak business to go under, and it's easy to just borrow money. So I think that one point to mention is just how different the bull market was in 2020 compared to 2021. The dynamics literally flipped. So the worst three performing sectors in 2020, which was energy, real estate, and financials in that order, were the three best performing sectors in 2021. Energy, real estate, and then financials. Tech did well, consumer discretionary did well too, but it's just interesting to see how the economy was propelled by different sectors, high oil and gas prices, etc. in 2021 compared to 2020. The really hyper growth names that really defined the bull market of 2020, like the Teladocs, the Zooms, Fiverr, Upwork, gig economy stocks, etc., they did so well in 2020, and then a lot of them underperformed in 2021. In fact, I think that those three, Zoom, Teladoc, and Fiverr, were down over 40% in 2021. So it's just an important lesson to think about something that's hot one year might be cold the next. Bull markets can be defined by different companies, but the through line here is really that the big tech stocks kept gaining throughout that 3-year period. And a lot of the energy names, real estate, those companies make up such a small percentage of the S&P 500. In fact, the energy sector makes up just 3% of the S&P 500, which is smaller than Microsoft. So Microsoft gains alone will be more important than the entire energy sector. And its gain of 50% in 2021 only contributed 1.5% to the S&P 500. So I think that when we look at the S&P 500, we think that it's representative of the broader economy, but in reality, it's not. It's really just representative of mostly big tech and the companies that have the high market caps in the index.
Should investors be looking at these big tech stocks as a larger part of their portfolio?
So I think that just how companies like Procter & Gamble are the consumer staple stocks, they have products that we use no matter how the economy is doing and that kind of just surround our everyday lives. The big tech stocks like Apple and Microsoft are truly not just becoming consumer staples, but also something I like to call enterprise staples or digital staples. They are just these underpinning factors that define the way that business works. And so are a lot of the slightly smaller tech stocks like Adobe, Salesforce, Shopify. These companies are essential, and it's very doubtful that they're going to lose a lot of money even during a recession because they're literally essential businesses, and consumers are unlikely to really reduce their spending too much from those companies when the economy is doing bad. I mean, phones are basically a consumer staple at some point, so are laptops, so are a lot of other products and services that those companies provide. So I think that one trend we really saw, especially in 2020, that carried over to 2021 and is still carrying over to 2022, is this flight kind of away from okay businesses that are cheap towards really good businesses that have long-term upside, even if they're at a premium price. So Apple, Microsoft, and a lot of the growth stocks, the profitable growth stocks, mega cap growth stocks, are very expensive, some of their highest valuations ever. Like we said, Apple and Microsoft alone gained $4 trillion in market cap between 2019 and 2021. However, what investors are seeing is that these are the kind of companies that I know I can trust. I know I won't panic sell them when the market crashes. And another driving factor that isn't talked about as much is just this trend toward index investing and exchange traded fund investing, where these indexes and ETFs have to hold a lot of those really big companies. Like an S&P 500 fund has to hold so many Apple shares that the more people, the more inflows you have going into index funds, it's going to really drive those big stocks. So it's really a case of the winners just winning more and the losers losing more. The pandemic really drove a lot of that index investing too, because you have all this surplus income, people aren't taking vacations, you have more discretionary money, stimulus checks, things like that. And if that piles into index funds, it can really drive those top names heavily. So I think Warren Buffett has, just to paraphrase, he says something like that, where it's better to pay a premium price for a good company than a really good price for an okay company. And that's a trend that might continue lasting for a very long time as people look for stocks they want to own that can actually help them sleep at night and don't go down like 70%.